Welcome to Investero. Real estate has always been one of the most powerful paths to wealth creation. It's an asset class that has built millionaires for generations, and in 2025, it continues to offer incredible opportunities for both beginners and seasoned investors. But starting out in real estate can feel overwhelming, especially with high property prices, complicated financing options, and the fear of making a wrong move. The good news is that anyone, regardless of their starting point, can begin investing in real estate with the right knowledge and strategy. Let's break down exactly how to start investing in real estate step by step, so you can take confident action. The very first step is understanding your financial situation. Before you even think about buying a property, why do you need to get a clear picture of your budget, your income, your debts, and your savings? Real estate isn't just about buying, it's about sustaining the investment. You'll need a deposit, usually around 10 to 20% of the property value, plus money for stamp duty, legal fees, inspections, and ongoing costs like maintenance and insurance. Knowing your borrowing power is crucial, and that's why talking to a mortgage broker or lender early is so important. They can tell you how much you can borrow, what kind of loan you qualify for, and how to structure it in a way that supports your investment goals. Once you know your financial capacity, the next step is deciding what type of real estate you want to invest in. Residential real estate is the most common starting point because it's easier to understand. People always need a place to live, so demand remains strong. You could buy a house, an apartment, or even a townhouse to rent out and generate passive income. Another option is commercial real estate, like office spaces, warehouses, or retail shops, which typically offer higher rental yields, but also come with higher risks and longer vacancy periods. For beginners, residential property tends to be the safest entry point because of the steady demand. The third step is research. You can't invest blindly in real estate. Location is everything. Good property in a growing suburb will outperform a beautiful property in a declining area. Look for regions with strong job growth, infrastructure projects, good schools, transport links, and increasing demand for housing. For example, in Australia, suburbs near new train lines or infrastructure developments often see rapid price growth. In the US, cities with tech growth or new industries attract waves of renters and buyers. The trick is to find areas before they boom, so you can benefit from the capital growth later. After research comes the decision: positive cash flow or capital growth. Positive cash flow means the rental income from your property is higher than the expenses like mortgage repayments, rates, and insurance. This gives you extra income each month and makes it easier to hold on to the property long term. Capital growth properties, on the other hand, may cost you a little more to hold because expenses might exceed the rental income, but they increase in value faster over time. Both strategies work, it just depends on your goals. If you want passive income immediately, focus on cash flow. If you're building long-term wealth, capital growth may be the better play. Now let's talk about financing. Unless you're paying cash, you'll likely be taking out a mortgage. Banks and lenders usually require a deposit of 10 to 20%. If you don't have enough savings, there are creative options. Some investors use equity in their own home to fund a new property. Others pool money with family members or use government schemes that reduce the deposit needed. The key is making sure you don't overstretch yourself. Property is a long-term game, and you need to be able to weather interest rate rises or vacancies without panic. When you're ready to buy, inspections are critical. Never buy a property without thoroughly checking it. Building and pest inspections will save you from costly surprises like structural damage or termites. Even if a property looks perfect from the outside, issues hidden in the foundation or roof can turn an investment into a nightmare. It's worth paying for professional inspections to ensure peace of mind. After buying, the next step is managing your property. If you don't want the stress of dealing with tenants, repairs, and rent collection, hire a property manager. They usually charge around 5 to 10% of the rental income, but take care of everything, which allows you to focus on growing your portfolio instead of getting bogged down in daily details. A good property manager will also screen tenants properly and reduce the risk of late payments or property damage. One of the most powerful aspects of real estate investing is leverage. With stocks, if you want $500,000 invested, you usually need $500,000. With property, you might only need a $100,000 deposit to control a $500,000 asset, because the bank provides the rest. As the property increases in value, you benefit from growth on the entire property, not just your deposit. For example, if your $500,000 property grows to $600,000 in 5 years, that's $100,000 in capital gains found, though you only put down $100,000 to begin with. That's the magic of leverage. Another strategy for beginners is real estate investment trusts, or REITs. These are companies that own and manage property portfolios, and you can buy shares in them just like stocks. REITs are a great way to get exposure to real estate without needing hundreds of thousands of dollars for a deposit. They're especially useful if you want diversification or you're not ready to deal with tenants. Of course, there are risks. Real estate is not a guaranteed win. Property values can drop, tenants can leave, interest rates can rise, and unexpected expenses can come up. That's why you need to have a safety buffer. Smart investor always has emergency funds, money set aside to cover mortgage. Repayments for a few months if something goes wrong. The biggest mistake new investors make is stretching themselves too thin and having to sell at the wrong time. Real estate is also a game of patience. Unlike stocks, property doesn't usually give quick returns. It's a long-term wealth-building tool. Many of the wealthiest people didn't make millions overnight. They built their portfolios over 10, 20, or even 30 years. If you're willing to be patient, disciplined, and consistent, real estate can be your pathway to financial freedom. Finally, one of the best things you can do is learn from others. Join property investment groups, attend seminars, read books, and follow successful investors. Their experiences will save you from costly mistakes. Real estate is complex, but it's also one of the most rewarding investments when done properly. So, how do you start investing in real estate? Get your finances in order, research your markets, choose your strategy, secure financing, buy wisely, and manage your property effectively. With time and patience, you can build a portfolio that not only generates passive income, but also grows in value, creating long-term wealth. Subscribe to invest